Hello, I'm Penny McPhee, the president of the Arthur M. Blank Family Foundation. On behalf of the Blank family, it's my pleasure to welcome you here this evening to this edition of our speaker series. When the Foundation's trustees launched the speaker series in 2007, we had high hopes. By convening individuals around ideas critical to Atlanta's progress, we wanted these programs to stir folks to action and around important issues. We never could have dreamed that 24 months later, we would be in the middle of the greatest economic crisis of our time. Yet, here we are, and we're not backing away from the challenge. So tonight, with one of the nation's most thoughtful business columnists, we'll take our crack at examining what has happened in the U.S. business and economic environment and what lies ahead. As with all of our speaker series events, success depends on having local partners ready to provide outlets and opportunities for you to take action on the issues we examine together. So I want to thank our partners, the Metro Atlanta Chamber of Commerce, the Georgia Chamber of Commerce, Junior Achievement of Georgia, and Consumer Credit Counseling Service of Greater Atlanta. The success of the program also depends on having the right collection of people in the room, all of you. Your participation is key, and we promise there will be plenty of time for questions and dialogue. Now, to introduce our speaker, I'm pleased to introduce Suzanne Boaz, President of Consumer Credit Counseling Service of Greater Atlanta, an extraordinary organization serving families in Georgia and across the nation. If you don't know CCCS, it's a nonprofit working hard to empower consumers to achieve economic independence. Lately, that has meant a heavy load of work with mortgage lenders and homeowners to try to keep families in their homes. The CCCS board is a who's who of the Atlanta business community, and we're excited to have many of Suzanne's staff and board members with us here this evening. These folks are dealing every day with the impact of the economic crisis. Suzanne, thank you.
Well, thanks to Penny and really to all the people at the Blank Foundation. You all have become great friends of ours, and we really appreciate it. We feel so fortunate to be here today. As most of you know, the Blank Foundation has really made a commitment to making lasting change in this community and in some other communities. And that mission is very much shared by us at Consumer Credit Counseling Service. Now, I'm going to go out on a limb right now. I'm looking around and I realize I am probably going out on a limb and saying that I'm going to assume that all of you are familiar with Consumer Credit Counseling Service and our work of helping people regain financial stability. But on the possibility that there's one or two or three of you who don't know about our work, I hope that you'll seek out during the reception one of our board members or one of our staff members who are here and just get your questions answered about the good work that we do. We're also going to have some material, I think, available after the reception that you can take home and look at. You know, the current state of the economy has really caused or created an unprecedented opportunity, if not really even a demand, for all of us to champion positive transformation in our community. But if we're going to do that, and if we're going to have the greatest impact that we can, we've first got to understand what got us here. How did we get to the place that we are? And then what are the most likely ways that we're going to be able to get through and shape the recovery? And that's really why we're here tonight and why the Blank Foundation has convened us. Breaking through message clutter is really a difficult thing these days. We all are bombarded day in and day out by messages. But our speaker, Joe Nocera, is an expert at breaking through clutter. He's plain spoken, he's direct, and he can communicate with equal relevance to people like me who grab the New York Times first thing in the morning, and for those people who are up late watching The Daily Show with Jon Stewart, and that's not me. Recently, Joe has been investigating and reporting on some of the most complicated issues that have caused our country's current economic crisis. For instance, in the January issue of the New York Times Magazine, he dissected how Wall Street's own risk management techniques really led to the collapse. Joe has been with the New York Times since 2005, and he writes a column each Saturday that I know many of you read. It's called Talking Business. He told me, for those of you who read last week's column, he told me he got a lot of flack about that one. So during the question-answer period, he wants questions, so you may want to ask him about that one. In addition, he writes a blog called Executive Suite, and he serves as a regular commentator on NPR's Weekend Edition. Joe is a celebrated and award-winning writer, and I could spend the rest of the evening talking to you about his awards, including being named as a finalist this year for a Pulitzer. But quite frankly, what I appreciate the most about him is that he contributes to the excellence of the two most important news sources for me personally, and I'm sure some of the rest of you share those news sources as important ones, and that's the New York Times and NPR. So without further ado, will you help me in welcoming to the podium what I call straight talking, let's get to the heart of the matter, Joe Nocera. Thank you.
There's something really appropriate about being introduced right about now by a credit counselor. I was reminded by John Baer, and thank you for inviting me, John, and the Blank Foundation, that my bona fides here aren't just as a business columnist. When I lived in Washington in the 1970s, there was a real estate bubble going on that crashed. When I moved to Texas in February of 1982, 2 months after the Hughes rotary rig count hit its all-time peak and went straight down for the next 4 years, at which point I left. Then I moved to Massachusetts just in time for the Massachusetts miracle. And you know what happened to that. So I've seen my share of bubbles and recessions and why they happen and what happens. And I have to say, the story doesn't really change very much. It's really the same as Dutch tulips, the South Sea bubble, the 1907 panic, the crash of '29. It just pretty much human nature, human behavior. I'll tell you the story. I'm in the South. I don't know if I can tell this or not. Sure, I can. My friend Jim Grant, who's a wonderfully wry, smart analyst and a very bearish sort of New York, said to me once, Joe, finance is like sex. What do you mean? Well, he said, science builds on a foundation. You don't forget science. Once something's been discovered, once it becomes part of the scientific foundation, it doesn't get forgotten. It gets built upon. And generations of scientists learn it, and they remember it, and they don't have to reinvent it. He said, finance isn't like that. Finance is every generation has to discover it for themselves, just like sex. They have to make the same mistakes. They have to have the same emotions. They have to discover the downside of greed. And that is really, in many ways, which I'm hoping we'll talk about tonight, not in the speech portion because, of course, I wasn't smart enough to write this stuff down, but when we have the Q&A, that is very much what has happened here. When you get right down to it, it is a generation of people who did not go through a depression and who never really learned the downside of debt, discovering for themselves what happens when you stop worrying and just think that everything's going to be great from here to kingdom come. I met the most optimistic. I was in Detroit yesterday, and I met the most optimistic man in America. And believe it or not, he runs Ford Motor Company, Alan Mulally. And he is as exuberant, as excitable, as funny, and as charged up as you can imagine a person could possibly be running a company that lost $14 billion last year. It's really quite remarkable. And you get out of his office after about an hour, and you say, well, of course Ford's going to be great. How can they not turn this thing around now? You know, I've just gotten the pep talk of my life from this guy about all their new cars, about all the things they've done right, about how they've changed the company, about how they're refocusing on Ford, the Ford brand, and getting rid of Jaguar and doing this and doing that. And I came out of there and I thought, oh boy, Ford, we don't even have to worry about this anymore. And I wound up thinking that optimism is a wonderful quality when we're in the middle of a crisis, or when you're running a company that's lost $14 billion. It really is. It keeps people going. It's inspiring. It keeps you from. It helps you get up every day and think today's going to be better than yesterday. And I wound up also thinking that FDR, you know, the ultimate optimist was FDR. And if you talk to people who were kids during the Depression, you know, my old mentor, Charlie Peters of the Washington Monthly, used to talk about how his parents would lean into the radio when FDR would speak, and how it gave them hope, even though they got up the next day and things weren't any demonstrably better, but they had always felt they had hope. Now, I'm a journalist, and journalists are professional pessimists. They are. They can't help themselves. It's not because we're bad people. It's not because we want the world to come to an end, although that'd be a great headline. But it's because, you know, the news is the things that go wrong, not the things that go right. And we tend to have a suspicious cast of mind, and we tend to have a more pessimistic cast of mind when a program is announced or something comes out. We don't look for what's right about it. We have a tendency to look for what's wrong about it. That's kind of that's our value to the society in many ways. But as a columnist, I have really struggled, and this is kind of the heart of what I want to talk about. I've really struggled to try and not get captured by the kind of eternal pessimism, because the true fact, the only true fact we really know about this crisis, or about how and when it's going to end, is that we don't know, and that we are in the middle of a time filled with considered opinion, guesswork, attempts to parse what's going to be right and what's going to be wrong and how it's going to come out, and what dumb thing the administration did today, and so on and so forth. And I just wind up thinking that, you know, when we look back at the Depression, we look back at events that are history, they always seem obvious in retrospect. And yet when you're in the moment, this is one of those moments, we're actually we're in something, we're going through something, and it is so hard to figure out in any reasonable way, you know, how it's going to end, when it's going to end. And anybody who gets up here and tells you that they know the answer is lying. So I guess that's an opinion. So let me give you some of the examples I have here. Nouriel Roubini, who's the great doctor, he's playing the Dr. Doom role in this crisis, says that the banks still have $2 trillion to write off. The IMF puts the number at well under $1 trillion. Who's right? It's impossible to know. GM and Chrysler, one's in bankruptcy, one's getting ready to go to bankruptcy. I mean, GM will be bankrupt within a week and a half. I believe they'll go into bankruptcy May 31st, is what most people say. In fact, apparently they just cut their union deal today, so that makes the prospect of them getting in and out of bankruptcy fairly quickly even more certain than it was just yesterday. But here are the questions that those bankruptcies raise. In a normal situation, companies go into bankruptcy and then they fight it out with the creditors, but there's always an assumption that they'll come out of bankruptcy and they'll have a viable business because their cost structure will be changed and so on and so forth. With GM and Chrysler, you don't really know. Are people going to buy cars from a formerly bankrupt car maker? Will the short-term pain of closing down all these dealerships and all the jobs that's going to cost in America eventually be outweighed by having smaller but profitable car companies? Will they make cars that appeal to Americans? That's such a big thing. I mean, right now, the administration yesterday, Tuesday, proposed these new fuel efficiency standards, very important, with dramatically higher efficiency standards than currently exist. But the truth of the matter is, if the price at the pump stays at $2, Americans have a history of, as soon as oil goes back down, switching right back to all the SUVs and the light trucks and so on and so forth, the gas guzzlers that they have historically. So as the administration pushes the car companies to make hybrids and more fuel-efficient vehicles, there's a real question, which I don't have the answer to, as to whether anybody will actually buy them. We don't know. I read recently that the Hope for Homeowners program offered loan modifications for 55,000 Americans in the last 2 months. Compared to what it used to be under the Bush administration, that's actually pretty significant. I mean, it used to be 24. I'm not kidding. And yet at the same time, in that same span of time, according to the same sources, 683,000 homes were foreclosed on. That's pretty terrible. This crisis will not end until this country has figured out a way to start mitigating foreclosures, or foreclosures just on their own begin to die down. I mean, the root of the problem was housing. The root of the problem still is housing. And nothing damages the country or neighborhoods or cities or people who live in those neighborhoods than foreclosures. The Treasury Department and the Federal Reserve have worked very, very hard to get credit facilities back up and running. They've spent well over $1 trillion to try and get securitizations back up and running, to get commercial paper up and running. Yet at the same time, consumer credit is contracting in this country. Right? She knows. In the third quarter of 2007, excluding mortgages, banks made $44 billion in new loans to consumers. And that's credit cards, autos, and so on. In the third quarter of 2008, they made a net $8.7 billion in new loans. That's a drop of 88%. In the fourth quarter, consumer credit actually declined by $19.5 billion, which is almost unheard of in this country. And in the last quarter, another $12.2 billion. So then you hit the real, this is where the rubber really meets the road. How do you think about that? Is that a good thing or is that a bad thing? On the one hand, of course it's terrible because, we need credit to revive, to get the economy back up and running. And it's also very clear that, for instance, perfectly creditworthy people are having trouble getting mortgages, especially jumbo mortgages. And I'm not just talking about people who would have qualified in a bubble. We're just talking about in a normal economy, in a normal environment. I have a very good source who works deep inside one of the major banks, who works in the small business area. And she has been feeding me lots of information about how small businesses are being particularly hurt in this crisis because banks are, just as a matter of course, freezing credit lines, withdrawing credit lines, shrinking credit lines, asking for all kinds of additional documentation that they didn't used to have to give, and in many cases causing small businesses to cut back themselves, to lay off people, and it becomes this vicious cycle. So, banks which were too loose with credit at one end of the pendulum are now probably too tight with credit at the other end of the pendulum. It's very, very natural. It's what happens when fear overtakes greed. And you can say, this is terrible. And then here's the flip side. Here's the flip side. What got us into this mess in the first place? Debt. That's what did it. And, you can blame Wall Street if you want, and securitizations, and all these fancy, derivatives and so on. You can blame predatory mortgage brokers if you want. The truth of the matter is, the entire country was living beyond its means on every level of society. So, the government was running deficits that were being essentially paid for by the Chinese. Companies were being financially re-engineered and taking on more and more debt, private equity and so on. And individuals, people, were doing the exact same thing. They were, we were at a point in our history where we were not having huge productivity. We're not having very large productivity gains. Incomes were basically stable. And yet, people wanted to continue to live better than they had before. And so, hence the home equity loan that gets taken out for vacations and to buy fun things like, 50-inch TVs. And there was the thought always that, well, my house is always going to go up in price, and that's going to take care of it. And then one day it didn't. I believe that we have a ways to go, that for this country to get healthy again, to get strong again economically, we have to bleed this out of the system. We just cannot, 6 months or a year from now, say, well, the crisis is over. Let's go back to the way we did it before. Let's start borrowing again. Because to do that is to risk just doing the same thing all over again, only maybe worse the next time. So it puts me in this kind of weird spot. So I'm a professional columnist. My job is to have strong opinions, okay? That's my job. If you ask me, is executive compensation out of control? Does Wall Street need to be better regulated? Should Apple do a better job disclosing the health of its CEO, Steve Jobs? I got a very clear answer. Yes, yes, and yes. And in the early days of the crisis, I wrote with a lot more certainty than I did now. For instance, a really good example of this is in the early days of the crisis, I had no problem saying, oh, those insolvent big banks like Citi and Bank of America, let's just nationalize them. That's no big deal. I mean, we do this all the time. But the crisis humbles you, I think, if you're in a position like mine. The administration, the TARP program has not been a disaster. And in fact, in some ways, it's actually worked pretty well. Some of the banks are ready to give back the TARP money. Some of them want to give it back, but they shouldn't, but we'll get to that in a minute. the point is that you start to talk to people and you have an open mind and you're really listening to people, and then the question of whether you should nationalize the banks or not becomes a lot more complicated and a lot more difficult. So, you know, besides the fact that they don't have the regulatory authority to take over a bank holding company, but even notwithstanding that, one thing that really stuck in my mind was somebody said to me, you know, Joe, the last time the U.S. government took over a bank, and I'm not just talking about one of those weekend takeovers where they close it on Friday and open it on Monday under new management, but a real takeover, was Continental Illinois in the 1980s. Now, that was a bank that got in trouble because of its oil loans. It went berserko on lending for oil and gas in the 80s. And it had no investment bank, like they all do today. It did not exist in 100 countries like Citi does today. It actually, I don't even think it went outside the state of Illinois because there were all sorts of branch banking laws that no longer exist in this country. How long did the government own Continental Illinois? 7 years. 7 years. I was amazed. If you did that today and the government owned Citibank for 7 years, oy, oy, oy. So let me give you another moment. I was on Charlie Rose one night with my colleagues Andrew Ross Sorkin and the estimable Paul Krugman. Yeah, we are at the New York Times. If you walk past him, he's the only Nobel laureate we have in the building. Anyway, we were on Charlie Rose, and it was the day the PPIP program had been announced. That's the private-public partnership. And we were, in typical journalist fashion, the thing had been announced that day. This was instant analysis that night. We're busy in the green room reading about, oh, yeah, I'm going to be intelligent on this. And we were all pretty negative. Here's all the reasons why it won't work. You won't have price discovery, and you won't be able to do this, and it's all going to be for the big boys on Wall Street. And then these two guys came on after us who were actually in the marketplace. One of whom is a friend of mine, so I actually somebody I've been giving me a lot of straight talk about the crisis. And he said, oh, yeah, he said, I think this could work. I think this is a good step. If you combine it with the stress test, if you do this, this, and this. And it really caught me up, and I really thought to myself, you got to be a little more open-minded about this stuff, even if you are a journalist. So we look back at the Depression today, and everything seems obvious and inevitable. When you're in the middle of it, nothing seems obvious or inevitable. And here's another famous example, 1936. People don't realize this because it happened a long time ago, and none of us were alive then. But GDP actually grew from 32 to 36 presumably because of the stimulus that FDR and his administration threw into the country, works projects and all sorts of programs, and they ran huge deficits. And just then, as now, there's another thing we forget: Congress was just as chaotic. There were just as many dissenting opinions. There was just as much pressure on the president to start to shrink the deficit and do something about it. And so in 1936, after 4 straight years of GDP gains, he thought, okay, the time has come. Let's try and balance the budget, and let's try and cut back on spending. And the result was disaster. Spiraled the country right back into the Depression, from which it really didn't emerge until the Second World War. And I think about that a lot as I listen to the debate about the stimulus and spending this time around, and the fear that if we were to do the same thing, if we were to decide, okay, we're through this enough, let's start reining in the spending, I do worry that for all the inflationary potential of the spending, that to cut it off too soon would mean throwing us back into a crisis. That is, I don't know this. I'm not saying this is going to happen. It's just that, it could, and it scares me. Having waffled now for the last almost half an hour, let me tell you the things I do feel that I feel fairly confident about this far into the crisis. And then I'll stop and we'll take questions for as long as you want to take questions, because that's really the fun part. Number one, this is not a depression. It's just not. In fact, it's not even close yet. You go to New York, and there are certainly a lot of investment bankers out of work, and there's a lot of other people who are suffering, no question about it. But there's still industry. The restaurants are still relatively filled. People are spending money, not what they used to, but I saw the same thing in London. Heck, I see the same thing in Atlanta. You have an unemployment rate of 9.3% or something. I think that's what it is. 9.1. Well, in the Great Depression, the unemployment rate was 25%. And women didn't work. This is 1 out of every 4 men was out of work. GDP was down 25 to 30%. Today the GDP in this country is going to be down like 2 or 3%. The stock market during the Great Depression dropped 90%. There was no social safety net. There wasn't unemployment insurance. There wasn't deposit insurance. There's a reason people stood out in the line trying to get their money, be the first to get their money out back then. Because if you didn't, you're going to lose it. It was a far more rural country then. And there's some amazing statistic that the majority of the farms in the United States during the Great Depression were in foreclosure. That's farmers couldn't make any money because the crops, it cost them more to produce the crops than they could sell them for. We're not there. And I don't believe we will get there. I do believe fairly strongly that whatever other complaints you can say about the government in terms of handling the crisis, and there's plenty of things to complain about, they have understood the importance of, making sure the banking system doesn't collapse, making sure that certain credit facilities, that commercial paper doesn't dry up, that money market funds don't break the buck, that true panic doesn't spread because of their actions. And so, their willingness to throw money at this thing has actually been a good thing. They may not have done it in the most appropriate or efficient way, but they've held back what could have been a much worse situation. Similarly, for all the talk about how we're like Japan and this is going to be the lost decade, I don't believe that's going to happen either. So what happened in Japan? What happened in Japan is that they had the real estate bubble to end all real estate bubbles. I mean, just astonishing. And banks made just the same kind of bad loans that our banks made during this bubble, only more so because the value of real estate was so much higher. And when that bubble burst, there was a general societal unwillingness to acknowledge that the banks were insolvent. And the result of that was basically economic stagnation for a decade. Why does that happen? Because it happens because if you're an insolvent bank, even if you're secretly insolvent, you don't really want to give a lot of loans because you're hoarding all your capital. For fear that someday somebody's going to knock you on the door and say, how much capital do you have left? And by the way, you're out of business. And so there's there becomes a pervasive fear in the banking industry. Everybody in a policy position in the United States knows what happened in Japan. They're very conscious of it. And you can argue that the stress test wasn't tough enough, that there are bad assets inside these banks that remain sort of unacknowledged because they're not marked on the books properly. You can make all those kind of arguments, and you may well be right. But the government is not going to let this lag, the banks be in this quasi-bad position for 10 years because they do understand what's at stake. William Seidman, who was a really great American who died about 2 weeks ago, he was the head of the FDIC during the savings and loan crisis. And he reminded me a few months ago, 3 or 4 months ago, that he reminded me that it took the government 7 years to really come to terms with the S&L crisis. That there was this long gestation period where they tried to ignore it away or hope that the economy would recover enough so that the S&L assets would be worth more. A lot of these S&Ls were insolvent, and they were very much like Japanese zombie banks. But then they eventually did what they had to do. The first law that George Bush the First, God, I hate saying that. It sounds so regal. The first law that he signed was a law that gave the FDIC and the brand new Office of Thrift Supervision the right to take over S&Ls and do what they had to do. And that's exactly what happened. And other people have told me, and I think this is very true, that in America, it takes us a while to get to the right solution or get to the right place. But we do eventually get there. And I do feel like a lot of what this administration is doing right now, and I feel this especially strongly about the president himself, is he's feeling his way. He's trying to figure it out. He used a great phrase in the New York Times Magazine. There was a great Q&A with him in the Times Magazine maybe about a month ago. And he used the phrase ruthless pragmatism as his way of trying to approach this crisis. Well, I don't think he's been as ruthlessly pragmatic as he could yet. But I think a lot of that is because he hasn't really thought about these issues. He didn't run for the presidency to manage a financial crisis. He came because he had an agenda on the environment and on education and on health care. And he's been stuck with this thing that he never really, and these other issues, he spent a lifetime thinking about them. He has very complex, fully formed opinions about what works, what'll work and what won't. You may disagree with him, but he can argue with you, and beat you in the argument, I might add. But finance is different because he hasn't spent that much time thinking about it. So he's a little bit the captive of his aides right now. But I don't think that will last forever because I do think that he is a guy who wants to be ruthlessly pragmatic, and he is a guy who wants to get past this thing. He does not want to let it lag for 10 years. He does not want to have zombie banks. It doesn't help him. It doesn't help the country. It doesn't help the Democrats. It doesn't help anybody. So, again, that's why I just do not believe we will wind up in this Japanese situation. Number 3, if we get through this in one piece, it will be in spite of Congress, not because of it. Congress has been terrible. Barney Frank told me once that he said, the two times in my career when my popularity sank to its lowest were one, when I was involved in that sex scandal 20 years ago, and 2, when I pushed through the TARP. And he said, the TARP, it was worse with the TARP. So you wonder why these guys don't want to take any tough stands or do the right thing. But when you think of some of the things they've done. Okay, the U.S. government owns 80% of AIG, right? Now, how are we going to get that money back? Okay, the way we're going to get that money back is to take the parts of the company that are crown jewels. And believe me, there are pieces of that company that are... AIG was brought down by 500 people in a company of 116,000. 500 people trading in London and Wilton, Connecticut. So that means there's 115,500 people who are working in other parts of the company. And many of them were making a lot of money. The insurance, I mean, it was a great insurance company. It had it's the only foreign insurance company that was allowed to operate in China, and that was even during Mao. Anyway, it has these assets, right? It needs to sell them. That's how the government's going to get their money back. Why is it in your best interest, if you're a congressman, to bring up the brand new CEO of AIG and yell at him and tell him his company is terrible and he's an idiot when you're trying to sell these assets to make money for the taxpayers? Can someone explain that to me? It's nonsensical. It's astonishing to me that Congress turned down the TARP the first time around, which sent the stock market down 800 points the next day and created real panic throughout the world. There's a case right now with Wells Fargo. Now, this is an interesting, complicated situation. Wells Fargo is the banker for a company called Hartmarks, which makes suits. And it's I think it's the last manufacturer of suits in the United States. Now, obviously, the people who work at Hartmarks want to save their jobs. And by the way, as a matter of public policy, that's probably a good cause, something we probably want. But the local congressman who used to work at Hartmarks has basically said that if Wells Fargo liquidates the company, he will, and by the way, they're in bankruptcy. I almost forgot that part. He says that if they liquidate the company, he will be their worst nightmare, quote unquote. Now think about it. How did we get into this problem in the first place? We loaned money to people and companies who couldn't pay it back. So why is it good public policy to loan money to Hartmarks, which is already in bankruptcy, that apparently has no way of paying it back? Congress should let bankers do the banking. It's also why all these companies are now racing to give back the TARP money, because they don't want they don't want Congress in their business, because there's not a lot of upside. So you have the Goldmans of the world and the J.P. Morgans of the world saying they're going to give the money back, but you also have the Bank of Americas of the world, which has taken $45 billion in TARP money, which has had to have over $100 billion of their assets, as they say, ring-fenced. That means the government basically guarantees the losses, and which has been told by the government that it has to raise more new capital than any other bank after the stress test. And they want to give the money back. That really tells you something about how terrified the bankers have become of Congress, and how much they feel that Congress meddling in their affairs is sort of borders on the irrational. I'm getting a little carried away here, but here's my third big point. The crisis will change behavior. And if it doesn't, we're all in trouble. It doesn't require a depression to change behavior. It just requires a jarring change in economic circumstance. And so let's review the 20th century along these lines. The Depression, which obviously had a searing psychological effect on everybody who lived through it, caused my parents, our parents, to become extraordinarily risk-averse. They didn't even want to make a down payment for a refrigerator, you know? Consumer credit grew very, very slowly in the 50s and 60s, primarily because of that attitude. And people were perfectly happy to put down 20% on a 30-year fixed mortgage which they, by the way, would then spend the next 30 years paying off. How many people do that today? Nobody. In the 1970s, our generation discovered the joys of debt. Now, why did that happen? It didn't happen because we were crazy. It happened because of the recession in the late 70s and early 80s that taught us, don't forget, interest rates were double-digit. Inflation was double-digit. And your money was in the bank getting a regulated 5.25%. Remember those days? And a toaster, probably, when you open up the account. Right? You were a fool to keep your money in the bank under those circumstances because inflation was eroding your money. Borrowing made sense because you were borrowing with tomorrow's dollar. You were borrowing with tomorrow's dollars. And so an entire generation gradually learned to start borrowing because it made economic sense. It was the right thing to do. They went into the market for the same reason. People put their money in money market funds, which were getting 14, 15, 16%, and then as that started to come down, and they started to realize, hey, I like this double-digit stuff. Let me give my money to Peter Lynch at Fidelity Magellan, see what he can do with it, you know? And that really is how the investing generation began, for all intents and purposes, with the bull market of the 80s and with the sort of change in habits and attitudes. So here we are now. We have just rediscovered the dangers of debt. We have also learned, thanks to the internet bubble and now the current market, that there are dangers in investing as well. There's not a lot you can do about that because we all have 401ks. We all have kids we want to send to college. We really don't have any other way to pay for a lot of that stuff. We don't have pensions have died down. But you can have a more diversified portfolio. You don't have to bet the rent on tech stocks. You can be a little more patient. You don't have to think you're going to get rich tomorrow. You know, all of those are lessons that hopefully have been learned. Ditto on the subject of debt. Hopefully, people have been scared enough and they've lost enough and enough pain has been inflicted on the society that we will have a next generation who says, I'm going to be different. I'm going to do it differently. I'm going to be a little less risk. I'm going to be a little more risk averse. You know, maybe not as risk averse as my grandparents, but I'm certainly going to take less risk than my idiotic parents did. Fourth, regulation will be inadequate. And I say this with some reluctance. In the 1930s, the Congress instituted something that wound up being called the Pecora Committee. It was run by a guy named Ferdinand Pecora, who was not a congressman. He was a chief counsel. And it was very much akin to, for instance, the Watergate Committee that we all remember, where, yes, there were senators on the committee, but it was really run by the chief counsel, the deputy chief counsel, and the staff. And it was a long-term investigative effort. The Pecora Committee actually lasted 2 years. When I go to Washington for a hearing, House Financial Services Committee has 70 members. Think about this for a second. It has 70 members. Every congressman is allowed 5 minutes of questions when they have a hearing. Tell me how you get anything. Tell me how you learn anything under those circumstances. There's no continuity. There's no sustained questioning. Somebody told me, somebody at the New York Times told me that at one hearing, a congressman was texting him saying, "What should I ask?" Don't put that in the paper. My point is that as long as you're going to build regulation out of that kind of investigative effort, you're not going to get very good regulation. The president is in a big hurry to get some regulations put on the table. The Procura Committee not only put some people in jail, which it really did. Richard Whitney was exposed, who was the head of the New York Stock Exchange, was actually exposed as a crook during the Procura Committee hearings. The committee hearings outraged the country because they really got to the root of the rot of Wall Street in a way that nothing that's happened on Capitol Hill has done in this crisis. I mean, most people don't even really understand a lot of what happened on Wall Street. And out of that committee, a regulatory apparatus was constructed, including the SEC, the FDIC, that lasted for 50 years. I don't think you can really expect any regulatory structure to last for more than 50 years. I think 50 years is a pretty good track record before it started to break down. It started to break down because innovation started to outrun it, which always happens. People started to find the loopholes, which they hadn't looked for a long time. And Congress itself started to kind of roll back the regulatory efforts because we were living in this era where the market was going to tell everybody that what went right, and we didn't have to worry about regulation anymore. So when I look at the current situation, you know, they've already announced a regulation about that they'd like to apply to derivatives. They've already also announced a regulation that they floated something yesterday about having a big regulatory body that would deal purely with consumer protection. The SEC is already starting to fight back on that. And what I fear is that without a true investigation into what went wrong and without some deep thought about how to get it right, we won't get it right. The Treasury Department still is way understaffed. There's nobody who has time to think about how to fix this stuff. They're doing everything on the fly. And so that's my fourth worry. My fifth, the fifth thing that I feel fairly sure about, don't ask me how, but the recovery, like all recoveries, will be from the bottom up. It is, for all the talk about banks, about the need to get the big banks to start lending again, it really has to do with confidence, with the restoration of confidence all across the country. It's not just about Jamie Dimon being able to start giving out more money. It's about community banks. It's about entrepreneurs. It's about just people starting to feel more confident about each other economically again. You can't know exactly when that's going to happen, and you almost can't. You can't plan for it. You can't even know how it's going to happen. But it happens, one person at a time, one loan at a time, one business at a time. And that's eventually how we will get out of this. It's a giant problem. And I mean, the way you phrase it, the answer is yes, of course. You can, the Chinese sustain too big to fail companies too. But is it bad public policy? It is terrible public policy. And, I was with a major banker. It was off the record, so I can't tell you his name. But I was with one of the major bankers, and I said, are you still going to have an investment banking arm? He said, of course I'm going to have an investment banking arm. And his basic position was that in a global world, you need global banks that can service giant companies like General Electric. And he's got a point. But as long as you have too big to fail, you're always going to be in the situation that we're in right now, which is, you privatize the gain, and you socialize the risk, or you socialize the loss. And that's where we are right now, where, we cannot let a Citibank fail. We cannot let a Bank of America fail. We cannot let a Wells Fargo fail. And America historically has been opposed to big banks. The populist movement. There's a reason this country didn't have big national banks. It had nothing to do with too big to fail. It had to do with kind of our own populism, our own agrarianism. Now I think if there's a case for not having huge banks, it's not because of that, but it's because of the too big to fail, which is very destructive. It's done, along with everything else, along with the amount of money it's caused the government to spend, it's bad for the psyche of the country. There's something really destructive if you're being foreclosed from your house because you made a mistake. And you know these jackasses at Citi are still getting big bonuses when they made mistakes that were every bit as big, if not bigger. So I don't know what the answer is. I mean, I do feel like we should bring back some form of Glass-Steagall. I do feel that banks should be small enough that if they failed, the world wouldn't come to an end. But there's also a third component, which is that the interconnectedness of risk worldwide is a lot of why you couldn't let these institutions fail. If AIG had failed, the real problem was not so much AIG, although that was part of the problem. It was that it was going to cause bank failures around the world. They had insured so much risk, they had insured so much debt, that if they had gone down, they would have brought down lots of other institutions around the world. They would have jeopardized the people who held the insurance, their actual insurance. They would have caused money market funds to collapse because they were AAA, and so on and so forth. So, you know, there's a third problem besides too big to fail, which is how do we reduce systemic risk in the system? And I have not heard anybody come up with a really good idea for that, other than, you know, ban all derivatives, which is just not going to happen, nor necessarily should it, I might add. It is painful to watch. Everybody has an agenda. They all know what they want to do with their 5 minutes. There is very little accounting knowledge or even corporate knowledge. Congress is about something other than that, and that is just never going to change. What you need is a strong Treasury Department that is believable and that has a set of ideas that Congress will accept. Right now, we don't really have that. Geithner stumbled coming out of the block with his tax problems. He's never really fully recovered from that. He, unfortunately for him, and it's not his fault, he has an affect, just a basic affect that does not instill confidence. He can't help it. He looks 30 years old, and his brow is always furrowed. And so, you know, he doesn't, but he doesn't have the set of ideas. Yeah, I mean, you can't believe how understaffed they are. I mean, it's like 10 guys in a room trying to save the country. It's not a great situation. And I do think that the country would be better served if these guys had a little time to think and come up with ideas that put ideas on the table that were done less in haste than they are right now. You just asked the world's most complicated question. Companies have a fiduciary responsibility to maximize shareholder value. That's the law. So let's start there. That is the law. Well, what does that mean, taking care of the company? I mean, in the 1970s, before the kind of shareholder movement took place, American companies were a lot more sluggish And CEOs were sort of more empire builders than they were worried about the shareholders. And there's a reason the corporate raiders of the 80s were able to gain sway, is because they were arguing that companies needed to be leaner and meaner and tougher and better able to compete, and they were right. And on the other hand, there's also no question that for at least the last 10 years, the pendulum swung so far the other way that CEOs would financially re-engineer their companies in ways that were not particularly healthy in order to, basically reward stockholders, including themselves, because they got so many options. And options, I think, were a big part of everything that happened. There are some companies that have achieved a balance, but here's an interesting example that kind of helps show you what the dilemma is. Target is under attack from a hedge fund guy, a very smart hedge fund guy. And in fact, they're going to have their annual meeting today or tomorrow? Soon, very soon. And he has put up some members for the board, and he is running for the board, saying that Target has not done enough for shareholders, and if you did certain things with real estate, and he has a certain set of ideas, you'd get the share price up and you'd add value. Now, I think it would be hard-pressed for most of us in this room to say that Target has not been a pretty well-run company. They've done a really good job competing. They're the one retailer out there that's really done a pretty good job competing against Walmart. But the stock price is down, the numbers are down, and they're vulnerable. So, is this hedge fund guy a force for good because he's going to put money in the hands of shareholders who are people just like you and me, who can then use that money and spend it and invest in different companies and put pressure on Target? Is that a good thing? Or should he just leave it alone and they should just go their own way and maybe lose their own way? I don't have a good answer to that. I don't think anybody has a good answer to that if they're honest. Because it's not just a case of let's take care of the company and that'll take care of everything, because sometimes it doesn't. And it's not just a case of let's just reward the shareholders and line our own pockets and the hell with the company, because that usually works out disastrously too. The best CEOs are the ones who really know how to balance the constituencies, who know how to do enough in the short term to make the shareholders feel like they're getting some reward, but do enough in the long term so they don't lose sight of R&D and product development. It's a very tricky thing to pull off. But there are some people who can do it, and it's kind of the holy grail. I know that's not what you wanted, but it's the best I got. I actually, Barney Frank has a really good line on this, which is, it doesn't matter what they are, it matters what they do. So who cares whether you're a bank or a non-bank? If you lend, you should be regulated as a lender. Who cares if you're there are mortgage brokers that are regulated. There are mortgage brokers that are unregulated. What matters is what your activity is, and so that's number one. Number two is, if you're an institution, you should have skin in the game. So part of the problem in the crisis was that nobody in the chain, from the person who found you the house, to the person who signed you to the loan, to the person who brokered it, to Wall Street, nobody had any incentive to be the person who made sure you paid it back. And that has a lot to do with how we got into this trouble. So number two is, if you're going to securitize mortgages, you got to keep some of them on your own balance sheet, because if they go down, you need to suffer. Number three, we have a mishmash now. It's so unwieldy. There are like loopholes and holes, and there's the OCC and the OTS, and there's about 5 different bank regulators, and yet countrywide, WAMU, AIG, and somebody else that went under, maybe were all regulated by the Office of Thrift Supervision, and they chose their own regulator. It's crazy. In London, not that this was perfect, and not that it didn't have its own, but in London, one of the things they did when the Labour Party first came in with Tony Blair was they took like 10 different regulatory agencies, they bundled them all and called it the FSA, and they had one body that basically regulated the financial system. We need, if not that, something along those lines where there's like 2 or 3 agencies with clearly delineated and broad mandates, that regulate different activities in the market. Maybe one would be everything having to do with consumers, whether you're an investor, whether you're a borrower, maybe one that had everything to do with lending. And one that had everything to do with investing. I'm just making this up. But the idea would be you need a more streamlined structure, but that also had fewer loopholes to dive through and hide under. And that's something that's really gotten us into a lot of trouble as a country. You ask a good question. First of all, I think in this crisis, a lot of journalism is looking for the green shoots because that's news. Journalists are always looking for what is different as opposed to what is the same. So I think there is more. I mean, at the New York Times, certainly we talk about it all the time, where are there signs of progress, where there's optimism, where is there something good going on. I don't think it's quite as one-sided as you would portray it. The responsibility of journalists is to tell the truth and let the chips fall where they may. There are some columnists who look on the dark side. There are some columnists who look on the bright side. I think you actually do get a pretty good balance on that. We were criticized a lot in the height of the crisis for, sort of trying to tell the story of the crisis in all its drama and darkness, but I feel like that was doing our job. Now we're at a stage where you kind of don't quite know where things are going to go, and so the journalism, I think, is a lot more trying to just figure out what are the numbers are saying. How do you read the data? I'm sort of more optimistic than you are about where the journalism is right now, and I think journalists feel a little chagrined that we didn't do a better job sniffing out the crisis, the problems before they took place, and I think there is a view among many people in our profession that we want to get it righter this time as we come out of it. It's only partly perception, Perception, which is kind of the equivalent of confidence, is hugely important. It's why people who have enough money to buy a house don't buy a house because they're afraid, they don't know what's going to happen tomorrow. I would argue, however, that the Fed has done a terrific job. I just don't see how you can criticize parts of the government, but I don't see how you can really criticize the Federal Reserve for keeping the system up and running. there are the private. The way I think about it is, at a time, just as during the bubble, everybody acted rationally, and it added up to a giant act of irrationality when you get right down to it. Right now, everybody's acting rationally. The private company that's not spending on, CapEx, not investing, because he's nervous about what the next couple of quarters are going to be like, that's not an irrational act. But it doesn't help. The Fed chairman is right. If he's not, until that guy's willing to start spending, we're not going to get out of the crisis. The banker that's hoarding its capital instead of lending because it's worried about capital shortfalls, that's not irrational, but it doesn't help us get out of it. I mean, the problem with perception and psychology and confidence is that you don't know that it's turned until it's already taken place, until you're past this point of capitulation, as they say. And we won't know when we're there until it happens. And there's nothing either the Fed can do or the private side can do really to change that. The CEO of the company has to start feeling confident enough that he has to start spending. Or maybe all his computers are starting to break down. He doesn't have any choice. And then he realizes that the world's not going to come to an end. And so he starts to spend a little more. I mean, it's this accretive, gradual process that you or I, none of us, is sort of in control of. It happens in this almost sort of magical way that we don't even know what's happening while it's happening until after it's happened. Yeah, that's right. I actually think we could wind up with I think we will wind up with an auto industry, but a smaller one. We are not going to have a large manufacturing sector because in a globalized world, we can't afford it, basically. Our high-end jobs are going to come from service, and whether let me rephrase this a little bit. America is a country with an astonishing capacity to reinvent its business sector, and that is one of its great strengths. We manufacture microchips here and also abroad. The cost advantage of manufacturing abroad is so powerful that it is almost impossible for this country to compete in any deep way with that. I was in China last year, and they were still in the middle of their boom, but their labor costs were rising to the point where companies were starting to move offshore to Vietnam. I mean, that is an unassailable. You can't turn back that tide. And one of the reasons you can't turn it back is because we are also consumers, and we like, as a country, cheap goods, and they help our cost of living. So, I think that we will ultimately have pockets of manufacturing excellence, places like GE, or we used to have giant steel companies. Now we have mini steel companies that do quite well. We have, Silicon Valley has created a surprising amount of manufacturing, some of which has moved offshore, but some of which is still onshore. And so my thought is twofold. The first is that we need to accept the fact that the vast majority of our jobs are always going to come from the service industry. And indeed, we even have to worry about that a little bit because India is doing a terrific job of taking away, accounting jobs. A lot of white-collar jobs are gravitating to India. But having said that, my optimism is based around the notion that we still have a very entrepreneurial, innovative culture, that we tend to kind of find new areas and find new growth areas, and we build from that. And so while it is not a great thing that we don't have a big manufacturing industry anymore, I don't think it means that as a country, we're going to fall apart or be a second-class power or anything like that. They do feel a need, I think, to be careful about who they nominate because, A, there have been a bunch of stumbles, and B, there's been controversy around some of the nominees. For instance, I think his name is Gary Gensler, the guy who was nominated to be the head of the Commodities Futures, what is it, the CFTC, the Commodities Futures Trading Commission, had in the past been a Treasury official under Robert Rubin who had opposed the regulation of derivatives. So his nomination is kind of on hold. So there's a lot of stuff like that. It's like, what are people's past and will they get held up? And also the Treasury Department just hasn't had enough time to nominate people, to figure out who to nominate, because they've just been going at this from day one nonstop. I mean, it's really that simple. Well, that's right, but what will happen is, as the economist's case for this would say, okay, if these low-end accounting jobs are gravitating to India, then America will come up with a new source of jobs, as we historically have, that are higher end, that are higher paying, and that serve the country better. And let's hope that's right. Thank you very much.